Welcome to the Commercial Credit Corner podcast with your host, Qualtik CEO Mark Pryor and Qualtik's President Mike Fletcher, here to give you commercial lending and credit insights to help community bankers manage their loan portfolios in an ever-changing economic landscape. Based out of the Qualtik offices in the beautiful Portland, Oregon, we look forward to diving into current events with some exclusive insights from experts in the industry.
So some interesting news to cover off from the last couple of weeks. The first thing that we're going to start with is an article from the Wall Street Journal published on August 11th. And the headline is San Francisco is sinking in bad hotel debt. And a quote from that article says delinquency rates for commercial mortgage-backed securities in San Francisco's lodging sector soared to 41.6% in June, and that's compared to 5.7% a year earlier. So a big adjustment there. It also points out that this is the highest increase among the 25 largest U.S. metro areas. And then the final piece that we're pulling out of this article here for discussion is that the visitor numbers remain low, with weekend hotel occupancy in the metro area down 22% since 2019 compared to a 4% decline nationwide.
And I mean, that drives it, right? That as you think about San Francisco and what's driving the pain there, it is certainly that visitors aren't coming anymore. That's not, they certainly are coming to some degree, but at a much slower and lower rate. And that's going to impact San Francisco significantly. It was actually encouraging to see that since 2019, there was only a 4% decline nationwide. And so, I think San Francisco is an outlier. It has to be an outlier based on that percentage number. So it's weird to find almost good news in that article, but at least for me, it was that it's only a 4% 5-year decline, considering the changes in travel patterns and habits. And I wonder too, and the article didn't talk about this, if you remove the 3-year, call it a 3-year COVID period from 2020 to 2022, things started normalizing, what would that decline look like nationwide? So it's a little odd, I know, on my part, to find something sunshiny in an article. It's certainly not sunshine from San Francisco's hotel sector, but nationally, while it's not growth, it's certainly not as gloomy as a lot of us thought it was going to be at this point.
No question, there's a big impact on what geography you're in. So the ability to really pay attention to the geography that's being analyzed is important. And clearly there's a lot going on in San Francisco, but I like your point there. From a national perspective, things are positively rebounding. So the next article comes from The Guardian on August 14th. U.S. inflation dipped in July as the Federal Reserve expected to cut interest rates. And a couple of the key points, and this is covered broadly out in the market right now, but prices rose to an annual rate of 2.9% in July, and inflation dipped below 3% for the first time since 2021. Investors are expecting the Fed to cut interest rates. That signal has been real clear that the rate cut is coming, and now it's just kind of a question as to whether it's going to be a quarter point or a half point. And there's a lot of whip in some of the discussion around some of these things. But any thoughts from you on this, seeing this inflation number dip below 3% for the first time in 3 years?
Well, it means that the last 2 years of rate cuts are finally having an effect, both from a jobs perspective and an inflation perspective. And they didn't just signal. The Fed chair said that that's what they're going to do. But to your point, how aggressive are they going to be? Is it going to be a quarter or going to be a half? I think we've been about a year and a half in waiting for this. The credit's been awfully tight. This is going to loosen that up. But I also think that people will stay on the sidelines to some degree, waiting for an additional follow-on rate cut. And we'll see what that looks like. But if I were going to bet, particularly based on the jobs figures, and they came out right after the last meeting, If I were going to bet, I'd bet it'd be half a point. As we probably should disclaim, we're not giving any advice here, but I am in the camp that they're going to be aggressive.
Pretty big adjustment there in those employment numbers.
Yes, well, yeah, it's still on the positive side of the ledger, just as slowed. It also appears that we have miraculously over the last 4 years avoided a recession, and our GDP is still high. By many, many economic measures, we're doing really, really well. I think inflation was the stubborn thing that was tough, and interest rates were high, in no small part to soak up a lot of the liquidity that went into the marketplace during COVID. So I think a lot of that liquidity has been soaked up. Inflation's coming down. Fuel prices have come down pretty significantly, so that's going to continue to impact a lot of inflation moving south. And we'll see what happens over the next few months. But my gut is that it's about half a point based on everything going on.
That we'll make a note of that. We'll make a note of that guess.
Yeah, the problem is I'm now said in a recording. So
right. So later on in this article, Paul Ashworth, who is the chief North America economist at Capital Economics, he basically says that he would describe the report as mildly encouraging. And the one other thing that I wanted to call out here is his focus on rent prices, which has been a big driver of inflation, and that they were slightly higher in July than June, even though that inflation number overall is coming down. So that's something that we're definitely keeping an eye on as it relates to the rent prices.
Yeah, and I've read several things. There's a couple of big things driving that. One is the rental market is bigger because higher interest rates, fewer people have purchased homes, and there's the end of the market that's first-time homeowners are shifting later and later, and there's been less of that. There's also an inventory issue, that there's supply and demand, that there's just not as many houses for rent. And the third thing it talked about was over the last 5 years, a heavy corporate push into rentals. They bought up a lot of large corporations, bought up a number of houses at a much higher rate than they have in the past. And a lot of that rent is being managed now by very big companies where typically it was done at a more localized level. And that's kept it relatively high. But with interest rates going down and people having an ability to buy houses and new build going up, because that will be driven by interest rates, I'm encouraged that number will start to go down.
Right. Yeah. So it was interesting to watch over the course of the last couple of weeks as some of these reports came out. You saw the stock market dive pretty aggressively for a few days and then come right storming back.
Yeah.
It was real interesting to see what happened from a narrative standpoint out in the media and from economists as that was going on. One of the examples I want to call out was posted on X, formerly known as Twitter, from Paul Krugman. He's a U.S. economist, Nobel laureate, academic, author, etc. And he was one of the ones that was having discussion around whether or not there should be an emergency cut, like the sky is falling kind of narrative that was going on there. And one of his tweets said, so even though I've been arguing for rate cuts, 50 in September for sure, I wasn't calling for an intermeeting cut because that might signal panic. But since we may be seeing a panic anyway, the argument loses its force. Real case for an emergency cut soon. So this was in the midst of that downturn, kind of this clinching, which then got retracted, less than a week later. But any thoughts around just kind of that angst that's out in the market?
Yeah, I think the thought is that he wrote that on August 5th. I wonder what he'd write today. Is that that's a 3 or 4 day window in which there was some, I think even shorter than that, where there was a big sell-off. I think the market settled down pretty quickly. I think the Fed chair did signal, I forget where they were at a meeting. I think it was in Wyoming. They were, and he said, we're going to cut rates. It now is, as of this recording, late August, and I don't think anybody's feeling that way. Nobody's certainly calling for an emergency rate cut. So it is funny how rapidly things change, and particularly with markets, people have gotten spoiled by how high the Dow trades and how well it's been doing over the last few years. But that didn't age well, what he wrote, considering where we are right now.
It is interesting to watch, to see just how closely people are watching things, and the concern. There's a lot of concern out there that there may be a tipping point where we just end up in this dramatic crash, and you can understand some of that, but the odds around a big crash seem to be diminishing as time goes on.
It does. Who knows, right? I mean, something could happen, but by many, many, many measures, our economy is in really good shape. If you look at the Dow, if you look at overall income, if you look at unemployment is super low. There are lots of measures to suggest that it's in good shape. This persistent high inflation and high interest rates tend to spook people. And you came out of that last meeting, they did not lower rates. I think there was some panic from that, and the jobs number comes out, and it's not negative, right? It shows slowing job growth, but it wasn't negative. But that was the entire point of cutting rates. You knew that was going to be a side effect. When you're soaking up liquidity, it tends to happen. You tend to have higher unemployment. But good gosh, we're still under 4%. So the Fed, I think in retrospect, will have looked masterful doing what they're doing. They had to soak up that liquidity. There was no question about it, or inflation would have stayed out of control. And now it feels like the worm has turned, and there's no reason to panic. It just goes to show that don't use a 2-day snapshot to make a decision. And I wonder if he could retract that August 5th posting, if he would do it.
Good question.
By the way, I'm not looking to pick a fight with the Nobel laureate.
Right. All right. The last article here that we have to cover is from Globist on August 16th. And the title is "This Expert Detects a Shift in CRE Bank Lending." Michael Tom, who is an attorney in business and finance department at Obermeyer, is quoted in this frequently. He emphasized the improved loan performance in several regions and is attributing this uptick to a combination of factors, including declining interest rates and refinancing opportunities that have emerged over the recent quarter. He says that lenders are more eager to get money on the street, and at the same time, the commercial real estate market is undergoing a shift, particularly in suburban areas. And curious to hear your thoughts around this article.
Yeah, it sort of aligns with what I've been thinking, and the good news is we have podcasts now to show that this is what I was thinking, is that this panic that the last 3 years we've been faced with around commercial, around office, around some other things, doesn't seem to be as warranted as I think a lot of folks have been pointing out. It is positive. A lot of what you're seeing is positive around commercial real estate over the last few months. I think this idea that banks are looking to put money out, that they have dry powder to do it, and the shift in interest rates that's coming will help the commercial real estate market. This shift is interesting away from urban centers and into suburban areas where they want to put money out. I do think they were probably over-indexed on lending into urban areas, and there's been some flight into suburban areas for commercial, so they'll probably focus more on those areas. But it's a giant category, very diverse, lots of different things in it, and it does appear that the doom that surrounded it is slowly dissipating, and I bet an interest rate cut will dissipate that even more.
That would make sense. There's one other quote to call out here. He says in this article, in recent months, there's also been a noticeable shift towards financing single-tenant properties, which offer more security due to the long-term leases. If you have a one tenant and it's 100% occupied for a 10-year lease, it gives that lender some comfort. So he pointed out that idea of single tenant properties getting more attention and moving in a positive direction.
That part of it is fascinating. It's the building we occupy is multiple tenants and is complex to manage. And my guess is they can lend it a category with 10-year leases with single tenants. They'll do that all day long. particularly if the underlying tenant is fairly stable. But shifts in commercial, but I still think as a category it's going to be strong.
I agree, Mark. And let's go ahead and kick this over to the recent conversation that we had with Tiffanie Horton, the Chief Credit Officer at LinkBank. It was a good conversation, always interesting to learn more about the backgrounds and the current thought process of Chief Credit Officers at banks. We're here with Tiffanie Horton, Chief Credit Officer of LinkBank. Welcome to Portland, Tiffanie.
Thank you.
Great to have you here. And we're looking forward to having a conversation about your background and things you're thinking about in the credit landscape. And we'll kick it over to Mark here to get us started in the conversation.
Hey, Tiff, it's great to have you here in Portland with us. One of the things I'm really interested in is your career path. Is how did you get into what you're doing, and how did you end up where you are?
So I started as a credit analyst right out of college at a small bank in central Pennsylvania. From there, I kind of latched on to the person who's now my mentor. She was the chief credit officer at that bank. And so I've spent the last 20 plus years following her from bank to bank until she retired. And then I eventually became a chief credit officer. So that would be my one piece of advice to younger people, is to find somebody out there as you're working through your career who's not only your mentor, but your sponsor, a person who will bring your name up in meetings, offering you for projects, or bring your name up related to promotions. Because as I look back over the last 20 years, having her as my advocate, now she's more like my friend, but having her involved in my career was certainly the most beneficial thing that's helped me get from credit analyst to chief credit officer.
Yeah, it's fascinating. I tell the story all the time that early in your career, finding a mentor, somebody that can move you along. And I had one. I had a great one that, for better or worse, a lot of what I'm doing and a lot of the way I think was shaped by how he essentially raised me up in the business and pointed me in the right direction. That's a great journey and a great story. And your entire career has been in Pennsylvania?
Well, I left Pennsylvania to follow the team to a small bank in Florida for a few years. And then we bounced back to central Pennsylvania to start Link.
Fantastic.
That's great. I would echo that too when it comes to finding a great mentor. I think it's in any industry. It goes a really long way to somebody who's looking out for you. And obviously you're adding value for them, or they wouldn't be putting your name out there. You continue to add value. I'm curious, earlier in your career, were there specific things that you thought were the way that banking worked, or you thought that were the way that credit and analyzing credit worked? And now with a little bit more experience and time, you go, wow, it's definitely a different landscape than what I expected.
Early in my career, I think I was focused on what was on paper and, what was within systems. But what I underestimated back then, 20 years ago, is the importance of building relationships across the bank, especially between credit and the line. It's so important if you want to build a good credit culture that as an analyst, you establish relationships with lenders, regional presidents, within operations, and that you cultivate that so that people are quick parent, they feel comfortable coming to you. I think if you end up working in silos, you're going to create a whole lot more risk throughout the entire bank than if you cultivate relationships and everyone participates in managing risk. And as a 22-year-old out of college, you certainly don't understand that. You think your job is to come in and calculate ratios and put it all on paper. But over time, you kind of learn how to build those relationships. And that's what makes for successful risk management within a bank.
Yeah, that makes a lot of sense. There can be certain pieces that are really hard to capture. Business and economics and relationships are more complex than just simply putting something into a calculation. That makes it.
I agree. The quantitative slant is hugely important. But to your point, great banks have personal relationships. and understand what is it a fit, is it something that the client needs, and is something the bank wants to provide. And I don't know that numbers always tell that story. I think it's very much should be very much driven equal parts as to a relationship. And I'm also wondering what you're most curious about in risk management with a forward look. I've been doing this long enough to see the changes and the things that stay the same, but what do you see relative to risk management? We were talking about before this podcast, technology embracement is now where 10 years ago you couldn't get a bank to even talk about having something that wasn't hosted. I see that personally as something in risk management that's become forefront and implementation and use of it. I'm interested to see what you think in the risk management world from a future perspective is coming.
Technology is certainly what I'm most curious about, and how we can use it in risk management to make us more efficient, make our lives easier, and produce better data. So when I started out in credit, we were hand typing everything in Excel and Word. In the last, 5 to 10 years, now that's all automated, but I think we can take it a lot further. Being at a small community bank, I'm really interested in automating pieces of underwriting, especially for smaller loan relationships. That's available to us now, something that we're working on. So I'm really curious as to where technology is going to go over the next 5 to 10 years, and how that's going to help banks move forward. Obviously, as a credit officer, I'm really interested in what's going to happen in the economic environment. When rates might come down, that affects our portfolio in a big way. So all those kind of things, curious about, but I can't necessarily control that. So working on finding, better technology and better utilizing it is what we're focused on right now.
Well, I was going to ask you about rates and use your crystal ball, but I think everybody's sick of that question as to when rates are going to move down.
Yeah, the technology you mentioned on the economic side, there's a lot of things you can't control, and it is something to be curious about. But the beauty of technology, it gives you the opportunity to really analyze things from a wide variety of perspectives, so you can then be prepared.
Right, and we can forecast risks, which is something that you can help us with. All that is exciting and something we need to be able to do in risk management.
We talk about it a lot internally and externally, but the advent of accessible technology for bankers is going to be, at least in my view, the next big wave. Banks tend to be slower in adopting technology, but they have begun to adopt technologies that are going to help them move into a whole new phase of risk management.
All right, let's shift gears just a little bit. I want to talk about things from an investment standpoint of something that you look back and you say, I'm really glad I spent the time or I spent the money in this particular area to advance something in your career. Curious to hear your thoughts around one or two of the better investments you've made in your career.
From a career standpoint, I think the biggest investments I've made that have paid dividends are in people. At Link, we do hire a lot of younger people, several of them right out of college, and just investing in them as people, training them, and then, being able to watch them succeed. I have a woman on my team right now who we hired out of college. She's been promoted, I think, 3 times. She now kind of runs our credit operations area. But just investing in her, finding, trainings for her personally, spending time with her, explaining, how her career can progress. She started as an analyst, but it wasn't really her thing. So taking the time to find out, what she could do, because she was super smart, she was a cultural fit, and then helping her find that career path, and now having a high performing employee. You can't really beat that. And so investing in people, and she's just one example, but as a senior leader in our company, the more we invest in people, there's big returns there.
Yeah, it comes full circle. You were just talking about how somebody invested in you, and now you're talking about the benefit on the other side. Yeah, like it's the relationship and the benefit there for both parties. You benefited in somebody investing in you. And then you've also benefited by investing in somebody else, and it's that's a beautiful thing like that.
Yes. So, Tiff, what are your thoughts on the current commercial lending landscape? Sort of ties back into that interest rate discussion we had earlier, I'm sure.
Right. So in central Pennsylvania, the lending landscape is still highly competitive for good deals. We're not seeing as many deals to get to look at, but what we do see is really competitive. We're looking at deals from a relationship standpoint, trying to get full relationships. So not just lend to somebody, but get the deposit relationship as well. Rates are playing a big factor in the environment right now, because projects that would have penciled, in a past rate environment when they were down 2 or 3%, they don't pencil anymore. So just finding those quality borrowers and projects to work on right now it's a hard task for lenders.
To tie into that, I'm curious. So you're talking largely from a future-based, this is what we're trying to do next. In this same environment, what are you expecting regulators or seeing the regulators being focused on as it relates to the book that you already have?
Right now, regulators are highly focused on CRE from a credit perspective. So they want to know how you can slice and dice your portfolio, that you know what's going on within the portfolio, that you can break out office space, particularly, that you can find out, the average loan to value, how many of those loans are guaranteed. Lots of data around CRE is what they're interested in, and that you understand that data and know what's going on within your bank. They're also interested in how you're managing the portfolio from a collection of financial statements, and that you're on top of that annual reviews are getting done. So they really want to know right now, especially in this economic environment, that you're on top of your portfolio and managing the risk within it, and that you can provide them with the data to show that you're doing so. From an overall bank perspective, a lot of focus on CRA, fair lending, obviously fraud as it's up right now across the industry. So they want to know how you're doing with fraud and the IT part of the business.
So I'm hearing you say that it's as much about process and demonstrating that you're able to identify and track and understand what's going on as it is about any one particular question. So let me state that in a slightly different way. In the news right now, there's all kinds of things about office, right? And you referenced office. But more of what I'm hearing you say is you think those regulators are coming in and saying, are you on top of your data, and are you on top of your process to make sure that you can identify risk as it's coming? Am I hearing that right?
Certainly. They want to know that you're ahead of it, that if there's an office loan or any type of loan coming up for a rate reset, that you have a plan as to how you're going to manage that credit. Does the loan need right size? Are you going to rely on guarantor strength? So you need to show them that future data, and then that you have a plan to manage the risk within that portfolio.
Yeah, makes a lot of sense.
Great, thank you. So what are some of the things outside of lending and credit that you use to sharpen yourself?
So I think when no matter what industry you're in, you usually get promoted because you're really good at tasks. So for me, I was good at underwriting, and I ended up getting promoted. What no one really teaches you along the way is how to be a leader and how to manage teams. So that's a big focus for not just me at Link, but for all of us. Our executive team is currently working together on a leadership program. So we're getting trained in being leaders. And I think that's really important, because you can be great at skills, but if you can't lead a team, it's not really worth being promoted, because that's what you need to be able to do.
That's fantastic. What particular things are you doing? Are you doing readings or the same outside of work? Are you watching mentors? Are you watching other styles? What are you doing to help on your leadership style?
Yep. We actually have a leadership coach. So she is facilitating a whole program for us that includes reading a book and then coming together to talk through different things. And we just started it. We had our first session last week. So she'll be continuing to work with us, and we think we're doing a pretty good job as leaders at Link, but we know that there's always room for improvement. So she's going to help take us from, say good to great, we hope.
I love that. Sometimes you can get in an echo chamber of your own leadership style, and or even as a small leadership team. I love that as an idea. Mike, I might put something on Qualtik's list now.
All right. That's we're always learning, right?
That's right. Tiff, we really thank you so much for coming here and being part of our podcast. And we loved your insights, really learned a lot. We also really appreciate the relationship we have with LinkBank as a very important customer of ours. We learn a lot from you and it helps make us a better company. So thank you again for coming.
Thank you.
Really appreciate it.